Hi guys, welcome back. Today we will be talking about cost of capital. To understand cost of capital, we should begin by understanding how a business is run. A business needs assets in order to function. And of course, assets needs funding. Capital is what we refer to as the source of such funds. It can come in the form of debt, preferred stocks, or common equity. Debt generally comes from bondholders, preferred stocks from preferred stockholders, common equity from common stockholders. Each capital component has a cost. We use R to denote such a cost. Hence, the cost of debt is R sub D, cost of preferred stock is R sub P, cost of common equity or common stocks, R sub S. Note that from the investor's point of view, the holders of such security, R is actually a return from their perspective. But from the point of view of the company, this is the cost of each capital component. We are talking things from the point of view of the company issuing the securities, and hence we will use the word cost to refer to such items. Let us refer to the following case to illustrate how the cost of capital is arrived at. What is the weighted average cost of capital, WACC, for a firm given the following information in the chart? Debt has an after-tax cost of 5%, representing 60% of the capital structure. Preferred stock has an after-tax cost of 7%, representing 10% of the capital structure. Common equity has an after-tax cost of 12%, representing 30% of the capital structure. To arrive at the cost of capital, we need to take the weighted average of all capital components costs using their corresponding proportion in the capital structure as the weights in arriving at such average. Hence, we can arrive at WACC by multiplying 5% times 60%, that's 3%, plus 7% times 10%, that's 0.7%, 12% times 30%, that's 3.6%. That would give us an overall cost of capital of 7.3%. Hence, we can say, whenever the company would make an investment decision, such as acquiring assets, 7.3% would be the reference point in determining whether such a project is worth investing in. Hence, any asset investment to be made by such company should refer to such cost of funding, which is in our case 7.3%. Let us now talk about each capital component costs one by one, starting with the cost of debt. The cost of debt, we are to use the market rate. In most cases, this is equal to the yield to maturity. Note that the cost of debt, or any capital component for that matter, pertains to the cost of new debt, or any capital component. That is, assuming we are going to fund a new project. Hence, market values are used instead of book values in arriving at the relative proportion of each capital component in the capital structure. The bond or debt holders technically receive interest. Since it is a business expense, it is tax deductible. Hence, taxes should be accounted for using the following formula times 1 minus the tax rate. Let us refer to the next case. for the cost of debt. JKL Incorporated has a cost of equity of 14% and a cost of debt of 9%. The firm is financed with 40 million pesos worth of common stocks and a 60 million peso worth of bonds. What is the WACC for JKL Incorporated if it is subject to a corporate income tax rate of 30%? To arrive at the weighted average cost of capital, we must first arrive at the relative weights in the capital structure of both debt and equity. The market values of debt, 60 million, equity, 14 million. That would give us a capital structure of 60% is to 40% for a total of 100%. Next, to arrive at the weighted average cost of capital, do not forget that we have to account for taxes when it comes to arriving at the cost of debt. WACC is equal to R sub D times 1 minus T times the weight of debt plus R sub S times the weight of equity. That would give us 9% times 1 minus 30% times 60% plus 14% times 40%. Again, we have to arrive at the after-tax cost of debt, and considering the cost of debt is tax deductible. That would give us a weighted average cost of capital of 9.38%. Next, let us refer to the cost of preferred stocks. As for the cost of preferred stock, this pertains to the dividends the preferred stockholders require. To arrive at the annual dividends, simply multiply the dividend rate by the par value. Once the annual dividend has been determined, divide it by the preferred stock price. Take note, unlike coupon payments to bonds, these dividend payments are not guaranteed, not a deductible expense in taxation. Hence, there should be no adjustment for taxes. Let us refer to the following case in arriving at the cost of preferred stock. Golden Mountain Incorporated has an outstanding issue of 100 peso par perpetual preferred stock with an annual dividend rate of 7.5%. If the stock price is 150 pesos, what is the required return on this preferred stock? Dividend per share. We can simply arrive at it by multiplying the dividend rate by the par value. 7.5% times 100 is 750. We may now arrive at the cost of preferred stock in percentage. R sub P is equal to the dividends payable divided by the preferred stock price. 750 divided by 150, R sub P is 5%. Hence, the cost of preferred stock is 5% in this case. And that is how you arrive at the cost of preferred stock. Next, let us refer to the cost of common equity. As for the cost of common stock, R sub S, the cost of common stock, R sub S, is more complicated. The returns to be given to common stockholders are not stated and hence are difficult to project. There are at least two ways to arrive at R sub S. We have the capital asset pricing model, CAPM, the dividend growth model, DGM. CAPM will be discussed in a separate video. For this video lecture, we are going to focus on the dividend growth model. Dividend growth model. We are going to use the Gordon growth model in performing this technique. We use the dividend growth model under the assumption that dividends will grow constantly in the future. We can assume the following equation. R sub S is equal to dividend yield plus capital gains yield. Basically, if you are a bondholder, you expect to receive interest. If you are a preferred stockholder, you expect to earn dividends. But for a common stockholder, there are two ways in which you can earn from your investment. You can earn by receiving dividends, hence we have the dividend yield, and you can also earn through the increase in the stock price, which is represented by the capital gains yield. So to arrive at R sub S here, we have R sub S is equal to D sub 1 over P sub O plus G. And this is the dividend growth model. Now let's talk about G, the growth rate here. What does G mean? G is actually the growth rate of the dividends and the growth rate of the stock price. G pertains to both of these growth rates. Although it's true that in a particular year, the growth rate of the dividend may differ from the growth rate of the stock price, we are assuming that there is a constant growth rate that will be true forever. And hence, the growth rate of the dividends and the stock price should converge. That is, in the long run, they should be equal. Again, G pertains to the growth rate of both dividends and the stock price. To understand why this is the case, imagine that it isn't true that the two growth rates are equal. Let us imagine that the growth rate of the dividends is greater than the growth rate of the stock price. What do you think will happen? Again, we're assuming that this will be the same rate forever. The same rates forever. If this is going to continue forever, there will come a time that the dividends will exceed the stock price, which is unimaginable in the real world. And hence, the only realistic assumption that we can make is that when we assume a constant growth rate forever, that growth rate will be the growth rate of both the dividends and the stock price. So, let us refer to the following case for the dividend growth model. CourseDraw Corporation is expected to pay a dividend of 120 the following year. Dividends are expected to grow at a rate of 3% forever. The stock price of CourseDraw is currently at 20 pesos. To arrive at the cost of equity using the given, we have R sub S is equal to D sub 1 over P sub O, the dividend yield, plus G, the capital gains yield. We have 120, this is the dividend expected to be paid a year from now, divided by 20 pesos, the stock price, plus 3%. We have an R sub S of 9%. The cost of equity is 9%. Now, let us make another scenario. What if a new stock issuance is needed to fund a project? We need to issue new shares to the public in order for the project to push through. What do you think will happen? The company shall incur flotation costs. To understand what the implications of such in our calculations will be, let us refer to the next case. Macduff Company just paid a dividend of 1 peso yesterday. Dividends are expected to grow at a rate of 3% forever. The stock price of Macduff Company is currently at 18 pesos. If new stocks are issued, a flotation cost equal to 10% of the price is expected to be incurred. So flotation costs are the costs necessarily incurred in order for an issuance to happen. When a new stock issuance will be made, there would be payments required to the investment bankers, underwriters, dealers, and any other interested party in the transaction. we collectively call them flotation costs. If we are going to fund this project using internal equity, talking about retained earnings, technically, retained earnings belong to the common shareholders, there will be no necessary adjustment in arriving at cost of equity. R sub S is equal to D sub 1 over P sub O plus G, the dividend yield plus the capital gains yield. This is equal to 1 peso. This is already paid, so let it grow by 3% to arrive at the dividend next year, divided by 18 pesos plus 3%. We have an R sub S of 8.72%. 8.72% is technically the cost of funding the project using retained earnings. Common equity funding that is already inside the company. But what if we're going to fund the project using a new issuance of common stock? We should adjust for flotation costs this time. R sub E, which is the cost of external common equity, this is equal to D sub 1 over P sub O times 1 minus F, where F is the flotation cost, plus G. This is equal to 1 times 1.03. Let the dividend grow for 1 year, since 1 peso is the dividend already paid, divided by 18 pesos times 1 minus 10%. Because there is flotation cost, the company will not receive the entire 18 pesos from the issuance. It will be less 10%, and hence the adjustment, plus 3%. We would have an R sub E of 9.36%. The cost of external equity is 9.36%. Let's wrap everything up for the cost of capital using the last case. Happy Bee Company is expected to pay a dividend of 140 the following year. Dividends are expected to grow at a rate of 2% forever. The stock price is at 20 pesos. It is subject to a tax rate of 25%. For new issuances, flotation cost of 5% is expected to be incurred. Other data about a new project's funding are as follows. Refer to the table. Note that we do not have the cost of retained earnings and common stock issuance yet. Let us arrive at the weighted average cost of capital. Again, to arrive at the cost of retained earnings, simply use the dividend growth model without any adjustment. D sub 1 over P sub O plus G, that's 140 divided by 20 plus 2%. The required rate of return on retained earnings is 9%. Next, for the required rate of return on external equity, you have D sub 1 over P sub O times 1 minus F plus G. Just adjust for flotation costs. You would have 140 divided by 20 times 1 minus 5% plus 2%. The required rate of return on external equity is 9.37%. Thus, we now have all pre-tax costs. All we have to do is to adjust the pre-tax cost for debt for the tax rate. That's 1 minus 25%. Then afterwards, multiply each component by their corresponding proportion in the capital structure. 6% times 1 minus 25% times 40% is 1.8%. 8% times 10%, 0.8%. 9% times 30%, 2.7%. 9.37% times 20% is 1.87%. So the overall cost of capital, the weighted average cost of capital is 7.17%. Okay? So we have now completed our discussion on the cost of capital. For any requests, please comment below. Like, share, and subscribe.